Okay, let's just dive right in. We need to talk about this financial black hole that we're all sort of orbiting. I'm talking about the U.S. national debt. Right now, it's sitting at around, what, $38 trillion? Dollars. It's a figure so vast that I think for most people, it's just become background noise. It's too abstract to even worry about.
Well, for a long time, there was a reason for that. There was a pretty rational argument for, not worrying. The standard line was always the debt doesn't matter or we owe it to ourselves.
Right. As long as the dollar is the world reserve currency, we can just keep printing.
Exactly. For decades, we've had this incredible privilege to essentially finance ourselves for free.
But the analysis we've been looking at, it makes a really clear case that this privilege is, well, it's expiring. This has stopped being a political debate about spending. It's now just a math problem. And the numbers have gotten so big that they're the ones in charge now. They're dictating policy.
And that's our mission for this deep dive. We wanted to find why that $38 trillion figure suddenly matters now. We'll get into some technical concepts like fiscal dominance, explain what that actually means for your savings, and then, look at history, see what the options are when a country gets this deep into debt.
Okay, so let's start with the most shocking piece of this, the thing that, according to our sources, changed everything. They call it the defense cross.
A very memorable name.
It refers to this critical line the U.S. government crossed in December 2025 for the first time ever. The government is now spending more on the interest payments for the debt than it spends on all of national defense.
Just think about that for a second. It's a staggering reprioritization of the nation's capital. And it wasn't even a choice. It's a structural shift. We're now spending more to service old debt than to fund our entire future security.
The numbers are what really make it hit home. The annual interest expense, just the minimum payment on the national credit card, it's running at $1.16 trillion.
A year.
That one line item is now bigger than the budgets for the Army, the Navy, the Air Force, and the Marines combined. We are more obligated to our bondholders than we are to our service members. It's unbelievable.
The analogy that makes it click is, the simple family budget. Imagine your household makes $5,000 a month. But for years, you've been spending $7,000. You just put the difference on a credit card.
And it felt fine for a while.
It felt fine because the interest rate on that card was 0%. The minimum payment was basically nothing.
The biggest interest-free loan in history.
That's a good way to put it. But then, in 2022, the Federal Reserve had to fight inflation, so they hiked rates. And suddenly that credit card rate wasn't 0, it was 5%. You apply a 5% rate to a $38 trillion balance, and that minimum payment just explodes, which is how we got the defense cross.
And this is the point of no return. This is what people call the death spiral, because the government is still running a deficit. So now they have to borrow more money.
Just to pay the interest.
Just to pay the interest on the money they already borrowed. It's a Ponzi scheme.
Well, that comparison, dramatic as it is, it points to the real trap, the one facing the Federal Reserve. Normally, the Fed sees inflation, and the playbook is simple. Raise interest rates, cool the economy down.
But they can't. They're completely trapped. If the Fed actually did its job today and fought inflation by raising rates, the government itself would be in catastrophic trouble.
Absolutely. If rates reflected the true cost of borrowing, that interest payment could shoot up towards $2 trillion, almost instantly. That kind of shock would probably cause a collapse in confidence in U.S. debt, a political crisis.
So if the alternative is the government collapsing under its own debt, isn't this something we've been heading towards for a while? Is this fiscal dominance thing really a new development?
That's the key nuance. It's a spectrum, not a switch. But we've clearly crossed a threshold. Fiscal dominance just means the national debt has grown so large that it dominates monetary policy. The Fed can no longer act independently. It's effectively forced to work for the Treasury just to keep the lights on. Its main job is no longer fighting inflation for you, the consumer. It's keeping borrowing costs low for the government.
And that implies there's really only one way out. If you can't raise rates, you have to turn the printing presses back on.
That's the consensus from all the analysis. The Fed will be forced to lower rates or start printing money again, quantitative easing, to buy the government's own bonds. And we have a perfect real-world example of how this works. We just have to look at Japan.
Right. Japan literally invented this tactic, yield curve control.
Yield curve control, or YCC. It's a promise from the central bank to buy whatever amount of government debt it takes to pin the interest rate at some fake low level. If the rate starts to rise in the market, The central bank just steps in, prints money, and buys the bonds to force the price back where they want it.
But if the government is the main buyer of its own debt, using printed money, then the whole idea of a free market for U.S. bonds is just dead, isn't it? The price is fixed.
It's dead, exactly. If the Treasury needs to sell $1 trillion in new bonds, but nobody wants to buy them at the low interest rate they're offering, the Fed just steps in. It becomes the buyer of last resort. It ensures the government gets its funding, but the cost is paid through currency debasement. And the consensus is the U.S. is being forced down this exact path.
Okay, so that's the trap. Which brings us to the big question everyone always asks. Will the United States actually default on its debt? Will they just stop paying? And the answer from economics is always a clear no. A country that prints its own currency never really goes bankrupt. They just choose door number 2.
And door number 2 has a name, soft default. It's just a less scary phrase for inflation. The government never officially breaks its promise. It just prints the money it needs to pay the debt. And in doing so, it reduces the real value of that debt over time.
This is the part that matters for you, for anyone listening. They don't take your money. They just systematically destroy its value. Your bank account still says $100.
The nominal amount is protected.
But that same $100 buys way, way less at the grocery store.
And that loss of purchasing power is the mechanism. When you use inflation this way to reduce your debt burden, it functions exactly like a tax.
The ultimate tax. It's one that nobody voted for and nobody can dodge. It hits every single dollar you own, whether you're rich or poor.
The more technical term for this whole strategy is financial repression. It's what happens when the government and the central bank work together to keep interest rates artificially below the real rate of inflation.
So let's be really clear about who wins and who loses in that scenario.
The winners are the biggest debtors. And the biggest debtor of all is the government itself. Large corporations with lots of old fixed-rate debt also win big. They all get bailed out by inflation. The real value of what they owe just melts away.
And the losers, the people who pay for the bailout.
The losers are savers. Anyone on a fixed income. Anyone who keeps their money in a basic savings account or in any investment that doesn't beat inflation. If your savings account pays you 2%, but inflation is running at 5%, you are losing 3% of your wealth every single year. You are the one paying off the national debt.
This all feels familiar, like we're walking down a path that history has seen before. And it usually doesn't end well. I can't help but think of the Roman Empire.
That's the classic parallel, and it comes up a lot in the sources. The Roman Empire did almost the exact same thing. To pay for their massive military, they started shaving a little bit of silver off their main coin, the denarius.
So the coin looked the same, it still passed as a denarius, but the actual value, the metal inside, was less and less each year. They debase their currency.
They tax the wealth of every single person using that currency without ever passing a new tax law. And history is pretty clear that this debasement created huge economic instability that, well, it contributed to the fall of the Western Empire. That's the scary precedent.
That is the doomsday scenario. But to be the realist for a moment, there is a more hopeful playbook, right? A more modern one, the 1940s. After World War II, U.S. debt was at 120% of GDP. That's even higher than we are today.
Right, and the 1940s is the textbook case of a successful financial repression. How did they fix that debt? They didn't pay it off, not even close. They inflated it away, the government put caps on interest rates, a kind of soft yield curve control, and they just let inflation run hot for a decade.
So the size of the debt stayed about the same in dollar terms, but the economy grew so fast underneath it that the debt just shrank. As a percentage of everything else, it sort of melted away.
Precisely. It worked. It saved the government from a crisis without an explicit default. It was a tough decade for savers, but structurally, the plan was a success.
Which brings us to the most important question for today. We have the Roman model and the 1940s model. Why can't we just run the 1940s playbook again? What's different this time?
Two huge things: demographics and our industrial base. In 1945, America was a young, growing, manufacturing superpower. We had the baby boom. We had the factories. We had the economic engine to grow our way out of it.
And today, not so much.
Today, we're an aging, service-based economy. And that $38 trillion figure, that's just the on-the-books debt. It doesn't even include the unfunded liabilities for Social Security and Medicare, which are another $100 trillion or more. It's a much bigger, slower ship to turn around, and we have fewer engines to power it.
So the inflation required today would hit everyone much harder, because we don't have that booming post-war growth to offset it.
That's the real consequence. Look, if the 38 trillion is a promise that can't be kept and the math says it can't, then the government has a choice. Who do they break the promise to? Do they break it to the bondholders by defaulting? Or do they break it to the people by destroying the value of the currency through inflation?
And which path does history show a government will almost always take?
Oh, history is very clear. You bet on inflation. Soft default is quiet, it's slow, and most people don't understand that they're being taxed. An explicit default would cause an immediate global crisis of faith in the US dollar. They'll always choose the slower, quieter option.
So that brings us to the final takeaway for you. If the central question isn't if the currency will be debased, but just how fast, what does the smart money do?
They get on the lifeboats, they move their capital out of cash and into hard assets, into real scarcity. Things the government can't print more of. They look for durable stores of value that will hold their purchasing power while the currency around them loses its own.
So here's the provocative thought we want to leave you with. If guaranteed inflation is the only mathematical solution to this $38 trillion problem, what does that mean for you? How do you need to start thinking about shifting from holding cash, which is a taxed asset, to owning scarce assets that can actually retain their value through this? What does real wealth retention look like in the age of financial repression?